Hi everyone, hope you're doing well. Today we're going to talk about Google because there's a lot of interesting stuff going on with Google the last few days, and I thought, you know what, we can do a dedicated video here to Google. So what we'll talk about is the dip that's going on today. Slight bit of recovery going on at the moment, but it's still down 2.5%. At one point it was actually a lot lower. I think it was down about 4% at one point. But even so, if we do zoom out a little bit, it did peak around about $193 around about the 5th of February. And since that time, Google stock is actually down 21%. So Google right now is actually officially in crash mode, down 21%. And we're going to be talking about this because I actually am a big fan of Google. I'm sure most of you guys are aware I am currently a shareholder of Google. I'm still up a decent amount on my position, but at these sort of levels, I'm a big fan. And in fact, right now, Google is my third largest position, and I am actively buying, and I am in a position where Google can come my largest position in the portfolio, which is, that's a big statement. If Google carries on this downtrend or stays at these sort of levels for the next kind of 6 months, I would expect Google to come my largest position in the portfolio, which is obviously quite a big statement when I say them sort of things. Right now, 20 times earnings, it does pay a 0.5% dividend, which is something to point out. Obviously, something new they've started, and even though it's not a game changer, that dividend's not going to make you a millionaire, it's still nice to get a little bit of a dividend, isn't it? Now, let's get stuck onto Google. So Google, one thing I don't think people realize is obviously the amount of businesses they own. They own so many companies out here. Everyone kind of already thinks about, the Google search. But one of the big growth drivers has been Google Cloud, and we know how profitable that can be. And that's the fastest growing part of the business right now when we look at like Amazon Web Services, for example. And all the other kind of businesses, like YouTube, you're watching YouTube right now, Android, as you can see here, AdSense, Google Maps, Google Chrome. They've got so many little income streams going on. Obviously, they've kind of got the big ones there, but there's also those little small ones on there. And with the small ones, you're kind of getting those free bets. So, for example, one of the free bets I always consider with Google is I'm also getting those kind of new growth drivers. So, something like Waymo, for example. Waymo has done very well. You can see here that the paid robo-taxis have increased to 200,000. This was actually from, I think it was only a few months ago. Yeah, the 27th of February, so not too long ago. So even this is a potential big growth driver for them. I'd love to go and actually ride in one of these cars. I think they're actually planning on going to 10 cities now, I think. And, this is potentially something that could be a major growth driver for the next 5-10 years. We'll see what happens. But the thing is at these sort of levels, at 20 times earnings, it's kind of like a free bet for me. I'm looking at that thinking, that's not priced in at all. And if it works out, fantastic. If it doesn't work out, it's not going to change the stock at all. And with Google, they've got the balance sheet where they can put a bit of money on it and see if it basically works. And, something like this, I'm looking at the likes of Tesla. Tesla's valued at 710 billion. And I would argue the case that at least half of that, 300 billion of that, is maybe even more than that. 300 billion of that is on the hope of robo-taxis and full self-driving. Well, the issue is that if full self-driving and robo-taxis doesn't work for Tesla, that's going to be a major stink for them. And same with other kind of businesses. With Google, because it's such an amazing business and it's not priced in at all, this is kind of like a free bet. So with Google, you're getting all these amazing businesses. I would argue it's one of the best businesses in the world because they've still got major growth drivers. You look at someone like an Apple, for example. I think Google's a better company than Apple because it's cheaper than them. Right now, Google's 20 times earnings. What's Apple currently trading at? Is it 30 something? 33 times earnings. At the moment, Apple's only growing 3% a year. You look at someone like a Google, for example. Google's growing 11% a year, and yet it's nowhere near satirized. Basically someone like an Apple. Everyone's kind of got an iPhone right now, and every so often all you're going to have now is the kind of little updates, isn't there? There's going to be those kind of little updates every so often that maybe gets people to go buy the new iPhone, or maybe they can get a new product out of somewhere, unless they go, I think they'll have to ask Steve Jobs for another product, because I think the last few products haven't been that good. But, they'll have to get a new product from somewhere. With Apple, it's very easy to look at how they're going to have success for many years. You look at like the advertising rates. Advertising rates are only going to continue to go up year by year by year. People are only going to use YouTube at the moment more and more and more going forward. So I really like Google from that point of view. And like I said, one of the big things that I like about Google right now is 18 times forward earnings. This is one of the best companies in the world, if not the best company in the world. And yet it's 18 times forward earnings. It just does not make sense, because you look at the average valuation. The average valuation right now is, 20 times earnings. The S&P is 20 times earnings. You talk about the average company in the market. The average company in the market, like, 5-6% growth a year, that trades at 20 times earnings, right? Google, one of the best companies in the world, is below the market average valuation. Look at something like an Apple, for example. In my opinion, Google's a better company than Apple. And even if you don't believe that, right, surely the gap's not like that. Because right now, that what that value is that suggesting that. I would say the gap is only, even if you think Apple is better than Google, you'd only argue the case. I wouldn't accept that you say it's massively better than them and it's only slightly better. And it's like all the other kind of companies in this kind of space as well. I'd argue the case that all the other kind of Mag 7 stocks, Google isn't that far behind some of these other Mag 7 stocks in quality wise, and yet it's far cheaper than a lot of the other stocks here. And like we said, going forward, this year we're expecting 11% growth going forward, nearly 11% next year going forward. Balance sheet wise, it's one of the best companies in the world. It's got an absolute cracking balance sheet, as you can see, only 3% debt to equity. It's got 95 billion in cash, and every year this company is throwing off another. Well, this year it's going to throw off another 110 billion in cash, which is just insane. Now, the news today, obviously, they've gone and bought a cybersecurity group, which is Wiz. Now, they have been after this for a while. I believe they were interested in it a while ago, but the offer was actually rejected, which was 23 billion, which is in last summer. Now, this is quite impressive. So, Wiz, from being valued, trying to take it over in 23 billion, by not taking it over in that time frame and now having to take over it just costs Google like an extra 7 billion in that time frame, which is crazy. Now, obviously, this is to compete in this kind of cybersecurity space. I think this is really good. I think we are going to come a lot more cybersecurity focused, and obviously that hopefully supports Google's business model a little bit more. Wiz as a business seems to be doing really well. Now, this is a concern. I'm not going to get too excited yet because I do wonder what is going to happen about regulator point of view. Are they going to step in with this? We will see. I'm a bit 50-50 on it, but if they do get past, I think it will be a good acquisition for Google. And even though it is maybe a little bit of a rich fee for it, because at the moment they are making, I think it's something in the millions. I've got it up here. So in February 2024, the company claimed to reach 350 million in average recurring revenue. So yeah, that is obviously, when you look at 350 million in revenue and then you pay in, what was it? Obviously that's a major premium on the company. So yeah, it is a craze. You'd argue maybe it is a big overpay from Google, but obviously when you look at a company of Wiz's growth plan, you look at this company right now, I think it is. So yeah, they did claim to be the fastest startup to ever scale from 1 million to 100 million in annual recurring revenue, which is obviously pretty good, which was from the February 2021 to February 2022. Now that's also, when you do consider like to that scale, is actually really impressive and probably shows, and already to have 45% market share of Fortune 100 companies, that is pretty impressive. And so, yeah, it does seem an overpay, but when you do look at the quality of the business, it's good. To get to that sort of level in 4 or 5 years' time shows you the quality of this business here. So yeah, it is good. I don't think I've seen a company scale up that fast, probably since Hims and Hers, and how fast they were able to scale up. So yeah, I think this is probably, it's an overpay, but I think it's okay, considering what Google have. When Google, if this was a major issue, like they had to take loads of debt on it, if they had to pay, big financing costs on it, maybe then you'd be a little bit concerned. But this is nothing for Google, because like we just said, but when we look at the balance sheet, they currently sit on a 95 billion of cash. This is only a third of the cash they've got on the balance sheet. And the other thing is that, oh, by the way, in another few months' time, they're going to have another 110 million coming in the next 12 months. Or you could look at this point of view, is the 30 billion they've just paid for Wiz. That for Google, that is 100. I think it's 101 days it's going to take them to earn that much to pay it off. So they're going to pay for this acquisition in 101 days, and it's paid for with the cash that they've earned through the business, and it's done. And it's basically, it's free for them then to see if that makes, millions and billions in revenue and profit going forward, then it's going to be worth it, isn't it? And that's sometimes the big thing is that, these acquisitions, maybe they paid up for it, but if it's a good acquisition for them and it starts paying them back really well, it's nice getting share buybacks, it's nice getting dividends, but the best acquisition a company can make is a business, and that business performs absolutely amazing for them. Look at the likes of Google when they bought YouTube years ago. When they bought YouTube years ago, people said it was a big overpayment. What did they pay for? Was it like 1 billion, 2 billion pounds for it? It was not, well, I was going to say it was nothing, but it was an okay amount. But I remember people saying like, oh, that's a big overpayment for it, and then within 5 years, everyone looked back and went, that was a brilliant move. Look at the likes of Meta when they bought Instagram. I think a few people when they bought Instagram were like, really? And then you look in, 5 years' time and you go, wow, that was an absolute fantastic move. So that's the thing, is that sometimes if you can make the right acquisitions, they can do really well for you and pay you back more than what, share buybacks and dividends ever can. But even so, let's not forget this company is very aggressively, doing share buybacks at the moment. So let's look at Google, because obviously, I said to you guys, I'm a buyer. I'm buying Google, and even at these levels, I'm really buying the stock. Let's have a look. Why am I kind of buying the stock? So I put 8, 9, and 11% on the high side. Obviously, this year the forecast to grow just above 11%. Next year 11%, and hopefully some of the new drivers like cloud and Wiz keep that growth at 11% on the high side. And then also I've factored a little bit of a slowdown in, which I don't think they'll slow down that much. I put 28% profit margins in. I think that's about fair. There could potentially be a little bit more metric expansion as the profit on that cloud keeps ramping up. So we have seen the metric expansion, as you can see here, going on with Google. They're up to about 28% right now. We'll see. I could argue the case that potentially go a little bit higher, but I thought I'd keep it at what it's roughly at right now. 20 times earnings, because I don't like to assume crazy valuations to start with. And you can see here, and I've also put a little bit of a share buyback in. And on the low side, you've got 50% upside. Obviously, maybe a bit disappointed if they did come up back and I'd only made 50% over the next 5 years, but I'd still take it. It's not awful. And like I said, when I do the low numbers and a conservative valuation, I want to see that I'll still making money on it. And obviously with Google, I'm still going to make a decent money on the stock. Mid side's pretty decent, high side even better. So you can see these numbers here. There's okay upside here, and this is not including crazy metric expansion. This is 20 times earnings. Now, like I said before, I think Google will have metric expansion because historically the company's normally traded at 20 times earnings. Right now, on the forward P rate basis, it's 18 times forward earnings. I just think this is not fair for a company like this. I think it should trade at the levels that a Microsoft trades at and Apple trades at, them sort of quality businesses. It is one of, if not the best business in the world. It should trade at more than a market average valuation. So if we do start assuming like there is a little bit more of an expansion on this company, and let's say it does go to where it normally trades at, which is like 28 times earnings, which I still don't think is like, we aren't suddenly gone from market average valuations to bubble levels, but a little bit more of expansion, which I don't think is too bad for it. And you can see here, what do I invest for over the next 5 years? It's to get a 100% return. And right now Google, on that low side, you're getting that 100% return. High side, a little bit more than that. And even on the high side, 130, 140%. If I get 130, 140% on Google in the next 5 years, I'll be really happy with that. And I'd probably expect to probably outperform the S&P 500 with those sort of returns as well going forward, which would be great. So and as well as that, 11%, that's still not with crazy revenue growth. If that can speed up a little bit, that's with no profit margin expansion. I mean, let's just say, for example, they do, get another 2% out of that profit margin next 5 years. It's even a little bit more there. As well as that, you could factor a little bit of a dividend in. I mean, obviously that wouldn't be much, if it's not 0.5%, but I think it'll do pretty well. I think when you want a sleep easy stock in your portfolio, probably one of your larger positions where you don't have to worry about it. I don't think you need to worry about Google that much. And if you want a nice attractive return, 100%, 100+% in the next 5 years for owning Google, I think I'll have that. That's a very much a sleep easy stock, and certainly for a large position in the portfolio, I think it is certainly a good one for a nice easy stock for the largest position, and that's why it's my third largest position. But if it stays at these sort of levels, or if it gets even better and the stock actually goes lower from here, If the stock was to go low from here, then obviously I'll just even more start buying up the stock as well. So yeah, that's the video for on Google, guys. I like it. I like the acquisition. Yeah, a little bit expensive, but when you're someone like Google, you don't have to worry about it too much because you've got one of the best balance sheets in the world and the amount of profit you throw off a year, so you can afford it. So yeah, great value, great growth. So many businesses, so many little free kind of growth drivers that you're getting here. Obviously, you're adding, Waymo, and obviously you got Wiz now coming in as well. Great growth, great valuation. Yeah, I can't complain. I think it's a fantastic business. And if you're not buying Google at these levels, I don't think you'll ever probably be a buyer of Google, which is fine. You can always, I'm only here expressing my opinion, and what I say isn't always going to happen or come true. But what I can see at the moment, it certainly looks like it has a pretty good future. So yeah, I'm a fan. Thanks for watching anyway. Hit the like button. I'll see you in a bit.